Hey everyone, welcome back to Corporate Decoder, the place where we unpack those dense corporate filings and find out what they really mean. Get ready because Powell Industries has just dropped their report, and it looks like things are heating up in the energy infrastructure world, but are they keeping their cool with their financials? We have an intriguing mix of growth and the ever-present risks in this industry to dive into today, so stick around. And hey, if you dig getting the inside scoop on companies without the corporate jargon, make sure you are subscribed and join our thriving community over on Discord, linked right down below in the description. Alright, let's jump into Powell Industries' latest financial report. This filing gives us a look at their performance up to the 31st of December 2025, covering the last 3 months of the year. First up is the balance sheet. This is like a snapshot of everything the company owns and owes at a specific moment in time. Over on the asset side, their cash and cash equivalents, which is basically money they can access right away, have seen a pretty nice bump, going from about $450 million at the end of September to just under $491 million at the end of December. That is good to see. More cash on hand always provides some breathing room. Their property, plant and equipment, which includes things like buildings and machinery, is sitting at a little over $111 million. This number has been fairly stable, suggesting they are not aggressively expanding their physical footprint right now, or at least not significantly within this quarter. Now, let's look at their liabilities, what they owe. Total liabilities have decreased from about $468 million to just over $425 million. That is a solid move in the right direction, meaning they owe less than they did before. And then there is stockholders' equity, which is essentially the owner's stake in the company. This has seen a healthy increase, climbing from about $640 million to over $668 million. This rise is mainly thanks to an increase in retained earnings, which means they've been making money and keeping it in the business. Switching gears to the income statement. This is where we see how much money they made and spent over a period. For the 3 months ending the 31st of December 2025, revenues came in at about $251 million. That is an increase from the same period last year when revenues were around $241 million. So, on the top line, things are growing. The gross profit, which is what is left after accounting for the direct costs of making their products, has also seen a significant jump. It is up from about $59 million to over $71 million. This is a really positive sign, showing they are either selling at better prices, managing their production costs more effectively, or a combination of both. And as a percentage of revenues, that gross profit margin has improved nicely, going from 25 to 28%. That extra 3% may not sound huge, but on $251 million in sales, that is a lot of extra profit padding. However, their selling, general, and administrative expenses, which are the costs of running the business like salaries and marketing, have also risen. They went from about $21 million to over $25 million. This means they are spending more to sell their products and manage the business. And as a percentage of revenue, these costs are now 10% compared to 9% last year. It is not a massive jump, but it is something to watch. Despite those higher operating expenses, the bottom line net income has also increased. It rose from about $34 million to over $41 million. This means they are more profitable overall this quarter compared to last year. And for investors, this translates to higher earnings per S-share. Diluted earnings per S-share went from about $2.86 to $3.40. That is a pretty good improvement, signaling better returns for shareholders. Now let's look at comprehensive income, which includes things beyond just net income. Here, we see a positive factor is the foreign currency translation adjustments. For the period ending the 31st of December 2025, this was a positive $2.1 million versus a negative $8 million the prior year. This means that changes in exchange rates were a tailwind this period compared to a headwind last year. This makes their total comprehensive income a healthy $43 million for the quarter, up from about $26 million last year. The statement of stockholders' equity shows the changes in the owner's stake in the company over time. We've already touched on the increase in retained earnings, but it is good to see the details here. They also recorded about $1.6 million in stock-based compensation, which is essentially the cost of giving employees stock or stock options as part of their pay. This is a normal cost of doing business for many companies. And importantly, they paid out dividends totaling about $3.3 million for the quarter. This shows they are returning some profits directly to their shareholders. Let's move on to the cash flow statement. This is crucial because profits on paper do not always mean cash in the bank. Starting with net income, that was about $41.4 million. Then we add back depreciation and amortization. which are non-cash expenses, adding back about $2.1 million. And here is where it gets interesting. Changes in operating assets and liabilities. Accounts receivable went up by over $28 million. This means they've billed customers but haven't collected the cash yet. That is a bit of a drag on immediate cash flow, but it is often a sign of increased sales. On the flip side, accounts payable actually decreased by nearly $20 million. This suggests they might be paying their suppliers faster, or perhaps some large bills came due. Overall, their net cash provided by operating activities was about $43.6 million. This is a solid number and shows that the core business is generating healthy cash flow. In terms of investing activities, they spent about $2 million on property, plant, and equipment. This is a relatively modest amount, reinforcing the idea that they're not aggressively expanding their physical assets right now. And in financing activities, they used about $14 million for shares withheld in lieu of employee tax withholding. This happens when employees pay off taxes related to stock awards using some of those shares. Putting it all together, their cash and cash equivalents increased by nearly $40 million during the quarter, which is a very healthy increase. Now, let's dip into the notes. These are where companies explain the details behind the numbers. Powell recently adopted a new accounting standard about how they report segment information. This means they are now providing more details on how their business is broken down and how they measure performance, which should offer more transparency. They've also provided a breakdown of their earnings per S-share, both basic and diluted. The diluted earnings per S-share, which accounts for potential dilution from stock options or awards, stands at $3.40. Under inventory details, we see that their provision for excess and obsolete inventories is a negative $8.1 million. This is money set aside to account for inventory that might not sell or has lost value. It is a normal part of managing inventory, and the amount hasn't changed drastically. Looking at their property, plant, and equipment, land has increased slightly to over $24 million, and buildings and improvements are holding steady around $133 million. In the revenue section, we learn how they recognize income. For most of their business, which is custom engineered products and systems, they use a method called cost to cost. Basically, they recognize revenue as they incur costs on a contract. This is a common practice for long-term projects. About 94% of their revenue comes from this method. Their backlog, which represents future revenue from existing contracts, is a substantial $1.6 billion. This is a strong indicator of future business, with about $933 million expected to be recognized as revenue in the next 12 months. When we look at where their revenue comes from geographically, the United States is still their biggest market, bringing in about $195 million for the quarter. Canada is their next largest, with about $32 million. Interestingly, their Middle East and Africa segment saw significant growth, going from about $4.5 million last year to nearly $10 million this quarter. Asia Pacific also showed strong growth. By market sector, oil and gas, excluding petrochemicals, remains a huge part of their business, providing around $98 million in revenue. The electric utility sector is also showing strong growth, pulling in over $69 million, a significant jump from last year. The commercial and other industrial sector, however, saw a slight decrease. Goodwill, which represents the premium paid for acquisitions above the fair value of net identifiable assets, is a little over $6 million. Intangible assets, like technologies and customer relationships, total about $5.9 million. They are not seeing any impairment charges, meaning these assets are holding their value according to their valuations. Under long-term debt, Powell has a credit facility with a commitment of $150 million. As of the 31st of December 2025, they had no amounts borrowed under this facility, but they had about $65 million outstanding in letters of credit, which are essentially guarantees for certain obligations. This leaves them with a good amount of available borrowing capacity. In commitments and contingencies, we see that they had $65.1 million in outstanding letters of credit. They also have surety bonds totaling a massive $433 million. These are often required for large projects. They also mention potential liquidated damages from customer contracts. There is a probable exposure of about $4 million, with a possibility of up to $4.5 million. They've recorded $3.1 million as a reduction to revenue for this, which means they expect to pay out a portion of that. This is a common risk in large project-based businesses. In stock-based compensation, we see details on their restricted stock units. They issued quite a few new RSUs in the quarter, and a lot also vested. They recorded about $1.4 million in compensation expense related to these in the quarter. Under fair value measurements, they detail how they value certain assets and liabilities. Most of their cash and short-term investments are valued based on readily available market prices, which is good. Some items, like contingent future payments related to an acquisition, are valued using unobservable inputs, meaning they are based more on internal assumptions. For leases, Powell primarily leases office and warehouse space. The total lease cost for the quarter was about $918,000. Their future minimum lease payments are expected to be around $1.5 million, with most of that due in the next couple of years. This is an important part. Powell operates as one reportable operating segment. This means the company is managed as a single unit, and the chief operating decision maker, whose role is filled by the CEO, looks at the whole company's performance. They regularly review revenues and earnings before interest and taxes, or EBIT. The disaggregation of revenue by country shows that the United States is indeed their largest market, followed by Canada. Notably, Middle East and Africa and Asia Pacific regions are showing significant revenue growth, which is a positive sign of geographic diversification. Their long-lived assets, primarily property and equipment, are also concentrated in the United States and Canada, with a smaller but growing presence in the United Kingdom. Finally, income taxes for both quarters, their effective tax rate was about 12%. This rate was positively influenced by things like the vesting of restricted stock units and an estimated research and development tax credit, and a peek at subsequent events, things that happened after the reporting period. On the 3rd of February 2026, Powell's board approved an increase to their quarterly cash dividend to 27 cents per S-share. This marks a slight increase from the previous dividend amount. Now, let's talk about the cautionary statement. This is where they warn us that some of their statements are forward-looking, meaning they are based on expectations about the future. They are saying that actual results could be very different from these expectations due to a variety of risks. They list out a ton of risk factors. Things like the cyclical nature of their markets, intense competition, and the potential for losses on fixed-price contracts are all big concerns. They also highlight supplier concentration, labor availability, and the impact of technological innovations like AI. On the financial side, global economic uncertainty, fluctuations in material prices, and the need for surety bonds are all highlighted. Failure to comply with loan covenants and customer credit risks are also mentioned. They also discuss risks related to their corporate structure, like provisions that could prevent a change in control, and even potential drops in stock price. Legal and regulatory matters are also front and center, including government regulations, ongoing lawsuits, and changes in tax laws. The management's discussion and analysis section is where the company really explains their own performance. They talk about their strong backlog of $1.6 billion and how commercial activity is favorable, especially in data centers and oil and gas. They seem optimistic about the oil and gas market, particularly with LNG projects, and are seeing good traction in electric utilities and commercial sectors. Revenue increased by 4% due to strong international sales, and importantly, gross profit jumped by 20%, with their gross profit margin improving to 28% from 25%. This is a really positive performance metric. However, SG&A expenses did increase by 17%, consuming some of that gross profit gain. Net income saw a solid increase of 19%, leading to better earnings per diluted share. Their backlog increased to $1.6 billion, a good sign for future revenue. Bookings also saw a significant increase of 63%. On liquidity, their cash and short-term investments are over $500 million. They believe this, along with their credit facility, is enough to fund operations and growth. About $92 million of this cash is held overseas. Their US revolving credit facility remains undrawn, providing a substantial safety net. Cash flow from operations was strong at $43.6 million, driven by improved earnings. Investing activities generated some cash, while financing activities primarily involved share buybacks for tax withholding and dividend payments. There have been no significant changes in their market risks since their last report. Management has confirmed that their disclosure controls and procedures are effective. Moving into part 2, which is other information. The company states that while they are involved in various legal proceedings, they believe these will not materially affect their financial position. No material changes have been made to their previously disclosed risk factors. Under other information, we see that 2 key executives, Brett A. Cope and Michael W. Metcalf, have adopted Rule 10b-5-1 trading arrangements. This means they've pre-planned the sale of a certain number of company shares over a specific period, likely to avoid any appearance of insider trading. The exhibit section lists all the supporting documents for the filing, including certifications and employment agreements. And finally, the signatures section confirming that the appropriate officers have signed off on this report. Overall, Powell Industries seems to be navigating a complex but growing market effectively. They've shown strong revenue and profit growth in this quarter, with a particularly pleasing improvement in gross profit margins. Their backlog is substantial, and their cash position is robust. The diversification into electric utilities and continued strength in oil and gas are good signs. However, they are not immune to risk, and the increase in SG&A expenses is something to keep an eye on. The company is managing its debt well and has a considerable amount of available credit, which is reassuring. The growth in international markets is also a positive trend. While they acknowledge potential liquidated damages and other legal risks, they seem confident these won't derail them. It feels like Powell is on a solid path, leveraging existing strengths while also working to expand into new and growing sectors. Alright, that is our deep dive into Powell Industries' latest filing. What do you think about their performance and their outlook? Let us know your thoughts in the comments below. If you found this breakdown valuable, hit that like button, subscribe for more corporate insights, and don't forget to join our growing community over on Discord, linked in the description. Thanks for watching, and we'll see you in the next one.